Hello and welcome to another episode of Full Court Finance here at Zacks. Today we're looking at both FedEx and Nike stock ahead of their upcoming earnings releases later in this week to see if either of these giants is worth considering to buy. But before we get into everything, I want to say remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we get into FedEx and Nike, as always, I like to do a broader market overview to give context of what's going on with both of these stocks before we consider buying them ahead of earnings. So the Dow closed at new records last Friday, which marked its 13th record close of 2021. Meanwhile, resurgent tech stocks helped lift the S&P 500 to new records last Thursday, having erased all of its recent losses. Plus, the Nasdaq is now trading just about 5.5% below its mid-February highs. This marks a pretty strong return after the tech-heavy index fell into correction territory, down over 10% from its recent highs just a week ago. So all three indexes were hovering around neutral levels as of late morning trading on Monday. And the recent comeback highlights the return of the cyclical trade as Wall Street dives into economically sensitive areas. Investors are also starting to look into reopening stocks as the vaccine continues to roll out. And the Biden administration's new push is to make the coronavirus vaccine available to every adult by May 1st. We also saw the passage of the new $1.9 trillion fiscal stimulus that's expected to help boost the economy. So these efforts and the possibility of a huge economic comeback, with economists projecting that we could see about 6% GDP growth in 2021 in the US, will help actually bring about a wave of inflation worries. So that was a big reason that a lot of people were talking about that sell-off happening. But interest rates are still historically low, and some of the inflation fears might have been a little bit overblown, at least for now. And the recent and relatively quick return in tech stocks also highlights the strength of these stocks and showcases why investors with longer term horizons might want to always consider looking for strong stocks to buy on the dip or on pullbacks, because they're common in very healthy aspects of all markets, and most savvy investors are jumping in whenever they see there's value to be had. So Wall Street dove into Tesla and Zoom and countless other stocks that had taken massive hits, with some of them down over 25% from their highs. So even if there was more selling, many people on Wall Street decided this is a good enough value, even if there's some near-term selling pressure. These stocks are just as good as they were before, and now they're 25% below where they were trading. So obviously, with longer-term horizons, it is a solid time to look into stocks, even though we're back at new highs with the Dow and the S&P 500, and the Nasdaq is trending back in the right direction. So obviously, I mentioned there could be more near-term selling pressure, volatility, but the overall earnings picture is really promising heading into these results we have this week. So for Q1, I just want to show some of our Zacks data and just how good things have turned in a relatively short period of time. So back in early December, our estimates were calling for Q1 S&P 500 earnings to climb about 12%. And as of Friday, the most recent data I looked at, we were calling for 18.5% top or earnings growth for the S&P 500. So from 12% expectations in early December to almost 19% as of this past Friday is what we're calling for Q1. And then overall, we're calling for 23.5% earnings growth for the S&P 500, which would mark a big comeback from last year's 13% decline, and actually top 2018's impressive growth just barely. And then we're calling for another 15% growth in 2022 and another 12% bottom line growth in 2023. So big growth this year, and that growth is expected to be built upon in 2022 and 2023. So some really positive signs on the earnings front, which brings us to FedEx, which is set to release its Q3 fiscal 2021 earnings on Thursday, March 18th. So this upcoming Thursday. And for those of you who might not know, FedEx trades under the ticker FDX. So we're going to take just a broader look at FedEx to see if it might be worth buying at the moment. So the stock has experienced a pretty nice resurgence during the coronavirus comeback. It did lose some steam over the last several months, and it's trading roughly 10% off its early December 2020 records heading into that release on Thursday. So that's the simple context, and now we'll go through the rest. So FedEx is a global shipping powerhouse that pulled in about $70 billion in fiscal 2020. The company is also committed to boosting its e-commerce business, which includes investing in optimizing that last mile residential deliveries. So that's that e-commerce business that's going to be key going forward. In the summer of 2019, the company essentially cut ties with Amazon. Wall Street appeared somewhat perplexed at the time, but FedEx has understood that it doesn't want to be in business with a company that has ambitions to do exactly what FedEx is doing. So instead, it began to focus on doing business with rivals such as Target and Walmart and all the other big retail players. The company is also expanding, obviously, its digital commerce and its business consumer segments while remaining focused on its business to business unit as well. The company has beefed up its automation efforts and is modernizing its express air fleet. The company also in December completed its purchase of e-commerce platform ShopRunner that aims to directly connect brands and merchants with online shoppers. So they're investing more and more in their e-commerce business. And we should note that the booming industry has miles of room to grow when overall e-commerce accounted for 15% of total U.S. retail sales, or about 20% excluding autos and gasoline. And FedEx executives see room for big growth in the international market as well. In last year, we should note that FedEx executives cut their timeline for their overall industry expansion as the coronavirus really pushed up the adoption of e-commerce into overdrive. So FedEx now projects that the U.S. market will reach 100 million packages per day by the calendar year of 2023. This was down from its pre-COVID projection of 2026. So that cut its projection of reaching 100 million packages per day as an industry by 3 years. And FDX expects 96% of this anticipated growth will come from e-commerce business. So with this in mind, FedEx topped our Q2 estimates in early December with its revenue up 19%. This topped Q1's 13% revenue growth and actually represented its strongest expansion since fiscal 2017. With this in mind, Zacks estimates are calling for its Q3 revenue to jump 14% to about $20 billion and help lift its adjusted earnings by a whopping 128%. FedEx is also expected to post similarly impressive top and bottom line growth in the fourth quarter to help lift its full year revenue by 15% to about $80 billion. Meanwhile, its adjusted earnings are expected to jump 83% this year, and they're expected to follow up this growth with another 5% sales growth in 2022 and 10% earnings growth. So some solid growth for FedEx this year and next year. With that said, FedEx has experienced some overall mixed earnings revisions recently. This helps it land a Zacks rank number 3 hold. That said, its outlook is still up big since before its Q2 report, and it's topped our bottom line estimates by an average of about 63% in the trailing 3 quarters. The stock also rocks A grades for growth, value, and momentum in our style score system. And we've seen some longer term positive revisions for 2022 in the past 7 days. So that's a positive sign for FedEx. Overall, the stock has crushed its industry and the market in the past year. It's up about 140%. And the stock's 2020 run helped it surpass its previous 2018 records back in October. That said, FedEx has slipped in the last several months, and at about $265 a share as of Monday morning, it's trading about 11% below its December records. With that said, the stock is trending back in the right direction. It's up about 13% since the end of January. FedEx is also trading in line with its own one-year median in terms of forward sales and earnings, and at a pretty big discount compared to its industry, despite outpacing it. On top of that, FedEx's dividend is yielding about 1% at the moment, and 14 of the 20 brokerage recommendations Zacks has come in at strong buys, with none below a hold for FedEx. So clearly, buying any stock during the near term is always going to be risky if you're trying to play it just for a post-earnings gain. But longer-term investors might want to consider FedEx because its business is never going to go out of style. People are always going to be having packages shipped. and e-commerce is just set to boom for years and years to come as people have gotten used to getting packages delivered, and FedEx is really heavily invested in being able to capitalize on that longer term e-commerce growth. So pay attention to their earnings release on Thursday, and it's certainly worth considering as a longer term investment as the stock sits about 10% below its December highs. And now we're going to move on to another big company that's set to release its results also on Thursday, March 18th, and that is Nike, which trades on the ticker NKE. And like with FedEx, we're just going to kind of do a broader, relatively quick overview of Nike ahead of their release on Thursday. So despite the rise of Lululemon and a resurgent Adidas in North America, Nike remains pretty much the undisputed giant in sports apparel and the sneaker world. And obviously it's no simple task to stay on top of an industry, much less one that's as fickle as fashion, but Nike has thrived because of its ability to create trends, constantly adapt, and attach that swoosh logo that's now iconic to the biggest sports athletes, the biggest sports around the world and the United States, and just cultural icons where it's now just as popular to wear sneakers off the court than it is on the court or playing any sports. Nike's brand carries weight around the world, and that's why it's cemented its place alongside the likes of Coca-Cola and McDonald's and Apple as one of the most valuable brands every single year throughout the world. So like all successful retail businesses, Nike has invested in the future through multiple shopping apps. Its impressive digital marketplaces also span from its own websites to a massive, massive reach that crushes Adidas and Lululemon and most other brands across social media, where people are now shopping directly from places such as Instagram. Nike is also a mainstay on the pretty huge secondary sneaker market, and it continues to master that art of limited releases and constant updates, where they're just people who are really into Nike are always looking for when that next sneaker or next variation of classic sneakers is coming out. Nike is also committed to digitalizing its supply chain for the future. This includes through acquisitions. The company is just trying to be more predictive based on demand from its customers. And Nike's transition to that direct-to-consumer model will help improve its margins. And it also includes sticking to its own brick and mortar business. So it's not just forsaking brick and mortar for e-commerce. It's just going to focus more on its own stores. And this has it focused on key locations that it sees as hubs of fashion throughout the world that then trickle down to other places. So that's from New York to Paris and lots of places in between. And yeah, they're just trying to update and modernize their own brick and mortar businesses. And as we mentioned with FedEx, they have plenty of room to grow in that e-commerce space because just the space in general has so much more room to grow. And they're also going to be able to benefit from brick and mortar is not just going to go away overnight. And maybe by the summer, if people feel more comfortable and things return something closer to normal, it'll be back and better than ever. So with this in mind, the company's sales jumped 9% last quarter, which was for the 3-month period ended on November 30th. This helped it bounce back after 2 down periods as its stores were pretty hobbled by the coronavirus. Wall Street didn't really care, though, at the moment because they're always looking ahead. So the stock was able to overcome what were 2 down quarters. And they were able to do this because its e-commerce unit continued to grow even as its overall sales declined. So its Q2 FY21 digital sales were up 80%. So 80% digital growth last quarter. With this in mind, the Zacks estimates are calling for Nike's Q3 revenue to jump over 8%, with its adjusted earnings projected to dip slightly to 75 cents per share. Overall, the company's full year 2021 revenue is projected to surge 15% to over $43 billion and then jump another 11% higher in 2022. These would both represent big comebacks from 2020's 4% sales decline, and they would actually both mark what would be Nike's strongest revenue growth since 2012. So both 15% and 11% growth would mark its strongest growth since 2012. So back-to-back years of really impressive growth is what we're calling for Nike. Meanwhile, its adjusted earnings are projected to skyrocket 85% this year and then another 30% next year. Like with FedEx, it's had some stagnant earnings revisions recently. to help it land a Zacks ranked number 3 hold ahead of its Q3 release. Meanwhile, the company has a solid history of quarterly earnings beats, and 15 of the 21 broker recommendations Zacks has for Nike are strong buys. So that tells you what analysts are thinking of the stock. Overall, the stock's up about 90% in the last year, which is a big number because we're now in that period where everything's coming off those coronavirus lows in the year ago period. The stock did get caught up in the wave of selling recently, but it has started to bounce back. This includes a 2.5% jump through morning trading on Monday to have it trading at about $144 per share, which puts it just a few dollars off its mid-January records. So this could mean Wall Street is pretty high on Nike stock heading into its release on Thursday, as it's trending back in the right direction after that downturn. Like I mentioned with FedEx, Nike does seem to be a solid longer-term buy. It's also paying a dividend. It's dominating an industry that's certainly not going out of style anytime soon, especially as more and more people are dressing more casually than ever. And as many people will start to transition maybe to more of a remote work, some days in office, some days, or maybe some people just, if they're able to, never do go back to the office. So companies like Nike could continue to grow in that athleisure space that was already popular when people were going to the office. And if you're not going to the office, you have far less reason to buy more and more quote unquote dress clothes. So Nike and both FedEx do appear to be solid longer term investments for years and years to come, as both are operating businesses that are set to grow and aren't going out of style anytime soon. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.